Joining us now with insights on how today's markets shaped up is Reko Nare from Anchor Capital. Reko, thanks so much for your time this afternoon. So earnings season in full swing, and let's just jump straight into it, starting off with Bidcorp posting an improvement in both its top and bottom line. SA and Europe posting some of the strongest growth, but overall growth has been slowing, right? Is this just a result of tough economic conditions?
Hi, Darlene. Thanks so much for having me. It's great to be on the show, and hello to your viewers. I'd probably summarize these results as resilient. It's a resilient set of numbers. They were slightly light. I think the market was expecting more. As you already highlighted, you did see some solid growth, and specifically despite the sort of the low food inflation that we've been sitting in, kind of specifically compacted to when this result was reported over. But basically, you've got revenue up about 4.3%. 6.8% in constant currency terms. You got some organic growth filtering through there by about 4.5%. So impressive, as I said, given the muted food inflation that the specific result is over. But I think what I would highlight when you look at the demographic and the geographic split there is that you did see margins improving within the UK business, the European business, the SA business, which is great. Those are strong performers. But the Greater China region continues to be a drag on this business. But yeah, I'd probably highlight and just say that I think is when you look at the share price reaction down 3% in response to this result, it essentially just highlights that, despite the HEPS being up 9.6% in constant currency terms, investors were expecting more. But yeah, looking forward to the next 12 months, I think, what management said specifically around food inflation and those trends, that's a key indicator to watch for this business.
Let's move over to the telco space with Blue Label Telecoms booking higher profits. That prepaid business still upbeat, and we are seeing a turnaround taking place, of course, at Cell C. The share price, however, down over 6%. Is there something I'm missing here, or are we perhaps seeing investors, traders booking some profits?
Yeah, I'd probably highlight, Darlene, that it's really the quality of the earnings that investors will focus on. So on one side, you had, of course, one could point to the fact that you had, HEPS up in the 200s, stronger margins, 24% versus the 22% that was expected. But I think one thing that investors would probably focus on is the fact that, revenues falling by about 4% to 14 billion rand. So that, along with the fact that one of the key parts of the business, that comm equipment company, the ARPU there and the subscriber numbers there seem to be declining. So of course that weighs on outlook when you look at this business. But as you highlighted, the fact that investors sold this specific company down 6.7% post the results means that the focus there will definitely be on the revenue numbers. But I think from my side, my commentary is almost saying I think it is certainly a cleaner business and better positioned post the Cell C kind of extraction. So I think that it's a cleaner business. I think it's a business that's better positioned, and I think we will see margins gaining and cash flow, specifically cash flow visibility and higher quality earnings going forward for this business.
Now, while we are seeing Blue's shares take a knock, Curro's shares are up over 50% today following a buyout offer from the Yani Mouton Trust. If this goes through, it'll result in Curro delisting. We'll unpack the numbers further in just a bit, but let's get a sense of what you've made of this offer.
I'd probably say the fact that Darlene, the share price is up 50% today means that it came as a surprise to the broader market. I think that's the first initial comment to make. One can argue around, sort of delisting, do we want to see further delisting from the JSE in already fairly thin market? But look, when we just look at the numbers and the way that we kind of digest them, they have tabled a $7.2 billion offer. It's not pure cash. You've got 6.6% of that coming from cash, 7.9% coming from Capitec shares, 13% coming from PSG shares. That does imply about a 60% premium to the last close being yesterday's close, 8 rand. So I think, it does feel like a fairly strong proposition that they're putting across the table. But I think the fact that, you've got Curro then transitioning to be a non-profit organization there, one can argue kind of a case to be made on both sides. They have said that this is a strategic rationale. They do see Curro as being best placed as far as expanding quality education in South Africa, and this is the best place to do it is through a non-profit PBO. But yeah, I think for investors, we want to see more businesses like this in the market, and the more choice that we have as South African investors, the better. So yeah, I think that's my initial read of this statement out from Curro.
And let's get into those numbers then, right? For the 6 months, we did see profits quite muted. And this, of course, on the back of stagnant student enrollment numbers, where we aren't really seeing growth on that front. And it's really been interesting to see what's been playing out in the education sector, where you look at the likes of your Stadios, the likes of your Advitech, that do have exposure to that tertiary market, faring a bit more well, and Curro with exposure, I guess, to just the schools kind of market, not really winning in this kind of economic environment.
Yeah, darling, look, I'd even take a step back from that and highlight the fact that, look, the bigger issue here is one of growth in the country. If we do get that 1 or less than 1% GDP growth that the IMF and the Reserve Bank are pointing towards, then yeah, that's really negative towards the sort of the broader economy and sort of the broader this kind of specific sector, along with consumer discretionary and consumer staples as a whole, because of course that has a complete read-through or direct read-through towards the South African consumer. So I think that's what you are seeing filtered through. And as we highlighted, even when we chatted the last time, we were chatting about the banks, in order to see kind of greater numbers, stronger numbers out of these specific parts and these specific sectors within South Africa, we need to see the GDP story improve. So I think that's probably my kind of the back of the matchbox comment on these numbers.
All right, let's hit pause on the conversation for now. Before we get to your stock pick, let's take a moment to touch on what counters your industry peers are watching closely.
ASML, for those who don't know, they make the machines that make the microchips, Dutch company. Huge moat as far as their technology is concerned. Nobody else can do what they do. They've had a big retracement since their highs of 6 months a year ago. I think they're at viable levels. Historic price earnings of about 25. I think their revenue and earnings growth going forward can both easily be in double figures, between 15-20% a year. And considering the capital spend that the likes of Google and Amazon and all these guys building all these farms are concerned, they're going to need those machines, and the cherry on top is ASML is going to sell them that machine and then charge them a fee to actually look after the machine. So it's both on the selling side of the capital product and in the maintenance. I don't think in the medium to the longer term there's anybody that's going to touch them, and if they can keep their margins in check, which they should, with revenue growth, turns into free cash flow, I like it.
I'm still local. I like Motus. I saw the trading update today, and one thing I think that's not very clear, even though they're saying that operating earnings will be up 4 to 6%.
Yeah.
I think what you have to look at that is that it means in the second half, they probably grew about 15-16%. They're definitely not getting hammered out of the market by the Chinese. They're participating in the market growth. And I think their aftermarket business must be catching a lot of traction. They also delevered quite a bit. Their interest costs came down quite significantly. So if interest rates continue to decline, they'll pay down a lot more of their debt. Their margins are widening because of their participation in that aftermarket. And it's trading really cheap. For a business of this quality to be trading at that 6-7 times multiple, I think it gives you a solid entry point.
So Motus and ASML, are these businesses you like, Reko?
Yeah, I think both businesses are fairly strong. They give you a completely different profile when you think of a local portfolio versus an offshore portfolio. But I think when I think of ASML, it's a business that we hold within our kind of high conviction offshore equity portfolio. It's a quality business. It's exceptionally well run, and like your guest highlighted, is the fact that because of that retracement that we've seen within the share over the last 6 months. It's trading on a forward PE of about 27 times, which is actually quite reasonable relative to peers. Valuation will always be what we'll rely upon here when we kind of guide us forward in these kind of companies. But yeah, as your guest highlighted, we also have a consensus expectation for earnings growing at about 17 to 20% for the next 3 years going out. But the one risk that I would highlight here is ASML is probably the fact that those geopolitical trade tensions, those remain kind of the key overhang from my side. Tariffs, export restrictions, currency volatility, all of that can kind of see margins and margin pressure. And then, of course, all of that can come through and cloud the macro, or rather the growth outlook for this business. But I think it's a company that we're happy to continue to hold. And then Motus, I'd probably just highlight here. So one thing, you did see in those results, strong cash flow driving gearing down, which is what we like to see. Gearing coming down from 1.9 times to about 1.4 times. So we like a business that's as your guest highlighted, that is buying back and looking to buy back its shares. That's a key catalyst. It means that management backs its own story. But yeah, improving profitability there, and a fairly strong balance sheet. So I like both businesses.
All right, you like both businesses, but those are not your stock picks, right? What are you picking today? Where are you seeing opportunity?
Yeah, so I'm going to pick Afrimat. I think every time I've been on the show, I've picked a share that has an A as a start. So let's continue that. So Afrimat, look, it's a share price that's come under a significant amount of pressure over the last year. But I think what you are seeing here is really a pure turnaround story. You've got bulk commodity strength filtering through in the results that came out today. Basically, domestic iron ore volumes up strongly. And then, of course, I think a big talking point from my side is the fact that you've got Lafarge finally coming in online. You're seeing those Lafarge quarries integrating and delivering better margin and kind of filtering through into the rest of the business. So yeah, I think it's a fairly diversified model that it's got. It's a pure operational turnaround, and then you've got the fact that, of course, that it leverages the infrastructure demand within the country. So that's AFT on the JSE, Afrimat.
Reko, let's leave it there. Thanks so much for your time and just sharing your analysis of trade at midday. Now that was Reko Nare from Anchor Capital.